Here is the dilemma. Hi, Dean Jenkins with FollowMeTrades.com, and this is the market update for the week coming up of June 1st, 2020. And the dilemma is a conflict between what the indicators are saying, what technical analysis is saying, and what your gut instinct is saying. And so right now the technical indicators, I'm showing the chart, daily chart for the S&P 500. And after the big drop in March, we were watching this move up, higher highs, higher lows, higher highs, and it's been an impressive move up. And it's gone through the Fibonacci retracement zone, these blue lines here, it's gone above the 200-day moving average. And it continues, higher high, higher low, higher high. Now, we do have a little bit of indication of some decrease in momentum to the upside, but this is still an uptrend. And so that's what the indicators and the analysis are showing. Now, I've drawn a line here, and this is not necessarily a resistance line, but if the up move goes above this line, then it's more than a retracement of the big move down. Goes above 76.4 Fibonacci retracement, it is a new uptrend. So we're not there yet, but we are in an uptrend, and we had a strong week last week. But the dilemma, as I said, is kind of any rational person is just kind of ticking things off in your head, going, there's 40 million Americans out of work, and surprisingly, Americans are saving at a record level. And you can just go through the economic indicators. GDP has been decimated, industrial production, you just go down the list. Earnings, a lot of the Q1 earnings were kind of locked in before the pandemic effects took place, but now companies are declining to offer forward guidance. Most of the S&P 500 companies go, we don't know what's going to happen. And again, the unemployment rate, the hit to GDP, kind of the reluctance of people to spend, and now on top of it, potentially, a very emotional and troubling situation with the George Floyd situation, and just the riots and protests, and just the angst, probably amplified by an already tense situation with the virus. And your gut instinct is things could turn negative pretty fast. So the indicators and the analysis are bullish, but there's this kind of underlying concern that things could turn around, and the impact of the coronavirus shutdown and maybe the impact of other socio-political things could be a catalyst for it to turn down pretty quick. So what do you do as a trader? And I wish I had a crystal ball, and I'm probably as conflicted as I have ever been in my trading career in terms of, do I trust the indicators? Do I trust the analysis of a continuing uptrend? Or do I go with my gut that says this thing could, the wheels could come off and this thing could start heading down? The answer has been the same throughout my trading career, from the point that I became a technical trader and have been successful at it, and that's trade the realities, man. Just trade the realities. And the truth is, we can do that. Whatever angst we're feeling or conflict we're feeling about the technical analysis versus, this kind of gut check about, man, this rally may not have been justified. There's a pretty good headline. I didn't read the whole article, but here on CNBC, the article says, investors are dangerously downplaying coronavirus and trade risks. And I think that's a reality to pay attention to. It's not reflected in the chart yet. On Friday, I was watching closely as the president made announcements about actions with China, Hong Kong, and it seemed like it was a fairly tepid response. I'm not trying to make a political commentary. It's just from the range of actions available, the ones chosen were not extreme, and it looked like the trade deal with China was very much protected and not put in jeopardy. And at the end of the day, Friday, the market seemed to like that. There was a continued rally toward the close. So what do we do? I am looking, the overnight futures for the S&P 500. It's this chart here. It's a 10-minute chart. Overnight futures gapped down pretty significantly, and then they've worked their way back up into that gap, and now they're reversing down again. Right now, the S&P 500 futures are down about 9 points, about 0.3%. This is implying, resistance into this gap and potentially a down open on Monday. Does that mean that the big move down started? I don't know. Don't know. And we'll just have to wait and see. Now here's the good news for us as traders is we don't have to guess what the market is going to do next. When the market reacts, there'll be time to participate in kind of a bigger move. If you think back to late February, early March, when this big move down began, right? Even if you didn't see it coming and didn't go short here, and even if you weren't sure if this was the big deal and you didn't go short here, you could have gone short here and participated in quite a move, right? And we did at Follow Me Trades. We made, we're up 36% profit. Most of it made up during this move here. We've caught some decent trades going up. We've got some longs. We made some profit in that. But so if this market is going to go down and it gaps down, pulls up a little, gaps down again, if it does that, we probably are going to go test these lows, and we may get an entry here or here, and there will be plenty of room for good trades to the downside. So if it's going to continue up, I just have a hard time believing there's going to be much momentum that challenging this prior high in the near term, next couple months. It seems unlikely. It really does seem unlikely. So if it's going to continue up, we'll cautiously go long. If it's going to break down, we will wait for some really good confirmation, and then I think we will have time to participate in a move. And so, the headlines, hey, the Dow is down 500, Dow is down 1,000. That don't be unnerved by that. Don't think you missed it. There's going to be plenty of opportunity, and we'll just, So just to kind of bring it all back around, is it's a dilemma. The analysis shows an uptrend. All kind of instinct would suggest there's a potentially big move to the downside coming. We just come back to the same answer. Let's trade the realities of the market, and if it's going up and we take some long trades, we'll have protective stops in. We will profit if it goes up. If it fails, it starts heading down, we'll get out with a small loss. If it's going to turn and head down, we will wait for high probability of that. We'll have protective stops, and if it really starts to drop, then I think we'll be in a position to make some profit. So the safest thing to do is to retreat into reality, kind of tune out the headlines. Certainly we pay attention to what's going on in the world and in the country. Want to be informed, but in terms of making decisions about where to put capital into trades, let's just be cautious, disciplined, and trade the realities. And that has served us well over the years, very well. So that's the update. And I sure welcome your comments, your feedback. All right, thanks.